Hi, Richard Martin from the Market Forecaster here. It's the 31st of August. I thought I'd start with a weekly chart of the S&P 500 and try and get a helicopter view of where we are in this cycle and what's likely to unfold. This chart, you can see, has some historic information on it, which includes the Freddie and Fannie collapse, Lehman, the TARP rescue announcement, all of the influences behind this very bearish phase that we went through the GFC. But where did it come from? As we pull this chart together, and not all the data is complete here, but we go back in time. We know that we came up from the 80s, including the 1987 crash, which was the 3-4 to complete the final leg up to the fifth at the dot-com high. From there down to impulsively down in an A leg, which then we saw the Iraq invasion and George Bush go in March 2003, and we had this corrective run up, this B wave up, which doesn't often extend as far as this particular one did, and in fact on the Dow, the leg higher was an extended flat correction, which we were a little bit unsure at the time, but indeed thought that this may have been the high around about April in 2006, but in fact not to be the case. We had a number of years of continued growth. But the importance here is that that was a double top effectively. We then broke down heavily into the GFC, which is similar. This pattern here, which is the whole relevance of why I wanted to do this particular video, is this head pattern here and this very weak right shoulder is not dissimilar from what we're going through at the moment with this sloping right shoulder here. But also from a timing perspective, this was in fact, that peak was made in October. Well, here of course we've come in April, but September, October were particularly weak times, and it just may be that this is what we're heading into now. Traditionally, September and October during to the report season, always a little bit weak, and in fact we are pushing down quite heavily as we speak. So there's no bullish sentiment. I mean, this chart does not align with the broader economist view, the lagging economist view that suggests that things are pretty rosy. We've pushed under the 50 moving average. We've got very bearish engulfing candles here. I thought that this rally might have taken us a little bit higher, and indeed the potential to take out the 1127 mark on the S&P 500 could have been there, but not the case. So where are we likely to head? Well, we've done targets before, but I wanted to point them out again. This line here is the double top target, the measurement from here to here, extended and over. This particular target down here at I think it's 790 or 800 can be measured through the Fibonacci extension. And as we measure the first leg down, go up for 2, this then allows us to look at an extension of 61.8%. That's the exact relevance and measurement extension, 61.8% of the first leg down. That's to there. One is exactly the same length as the first leg, and then 61.8% of the first leg gives us this further target down here. Now, traditionally these markets often move this way, and you can see the count here as we would measure 1 to 2, which gives us the end of the third wave count here. So 61 at 910, 1.618% at 910 gives us that extension, 61.8 percentage points above the length of this particular first wave. So it's a useful target to keep in mind. Most definitely we are not in any form of bullish situation at the moment. Of course these things can change and we might get another rally back up, but at this point, coming into these months, that it really looks like that this might let go and certainly get down to the 993, possibly down to a 1-for-1 at 912. And if the head and shoulders actually comes into play, and given the amount of bearish sentiments out there at the moment, really traditionally I would be a contrarian when you read and see how much bearish sentiment's there, but we know that there's plenty of cash on the sidelines, and we know that there's plenty of fingers on the triggers ready to be pulled in the event that this slide continues. So I think that this is going to compound the particular move. And remember, this is a wave 3 move down here. That's why they're the largest and most powerful, is because generally the market comes together at these points of recognition and says, all right, there's only one way for this market to go, and that is in the direction of the trend, and we are bailing out given that this is a bearish trend. So we would expect some quite vicious movement down here that's going to unfold over the next weeks and indeed months. So that's the video for today. I felt that it was really worthwhile showing you that. It's a big picture, one not to be discounted. Sometimes it pays to stand back. For more information, you can go to themarketforecaster.com.au. Remember that we've got 3 updates per week that are emailed out, and indeed a couple of videos as they occur. Alright, signing off. Cheers.